Today's presentation is Understanding TRS and Social Security for Educators. My name is Edgar Ortiz. I am a Senior Retirement Planning Specialist. My info is on the screen. You can make an appointment via email, phone call, use a virtual session, or if you're tech savvy, you can open up your phone to your camera selection, put it right over that nice QR code, and you can get access to my calendar, which will then allow you to make an appointment at your convenience. So TCG, we seek to deliver long-term investment and retirement solutions that provide peace of mind. We have well over 800 active plans. We manage about $3.6 billion, and we have about $10 billion under administration. So we provide administration for retirement plans to financial wellness solutions, and we're dedicated to making financial decisions as easy as possible. One of the great things is that we provide fiduciary protection. We manage portfolios on a fee-only basis. We are registered with the SEC, and we act as the investment advisor on the advisory committee. So let's jump right in. Understanding TRS and the retirement gap. On the left-hand side, you'll see that there's a pie there because income retirement is very different for Texas teachers than it is for their spouses and their neighbors. On the left-hand side, you'll see that educators in the retirement system, most of their retirement will come from TRS. And you'll see that a small piece of the pie will come from Social Security if you worked in the private section prior to coming into the school district, and the rest will come from savings. On the right-hand side, you'll see your neighbors, such as myself and your spouses and neighbors, and you'll see that most of their retirement will come from savings, and a portion will come from Social Security. So the pies look very different, TRS retirement versus corporate retirement. So let's dispel one of the biggest myths that come when you are in a TRS plan system. We talk about the rule of 80. What is the rule of 80 and why is it important? So the rule of 80 is the qualifier to be eligible for retirement. And the rule of 80 is the qualifier, not the percentage. And how you get to the rule of 80 matters based on the tier number that you are in. We will review some of those tier numbers as you can see in your statement so you can better understand that information. To be eligible for normal age retirement, you must meet one of the conditions within your tier. And the same is true for early age retirement eligibility. Looking at the rule of 80, how do you get to that number? The math is pretty simple. You take your age plus the years of service, and it needs to total 80. So earlier we talked about tier numbers. Well, how do I know what tier number you're in? So changes in the retirement plan over the years have resulted in several distinct membership categories with each own retirement eligibility requirements and early age reductions. So you fall into one of these three buckets, either a tier 1, tier 2, tier 3, tier 4, tier 5, tier 6. Let's go briefly over each one of these. Tier 1 and 2 current membership began prior to September 1st, 2007 and had at least 5 years of service on August 31st, 2014. Now, the retirement criteria for tier 1 and tier 2 is rule of 80 with 5 years of service, or age 65 with 5 years of service. So you simply need to get to the rule of 80 and have at least 5 years of service to qualify for retirement. Moving on to the next bucket, tier 3 and tier 4, membership began between September 1st, 2007 and August 31st, 2014, and at least 5 years of service by August 31st of 2014. Now, looking at the retirement criteria for these two buckets, it actually changes. So you have to be at least age 60, meet the rule of 80, and have 5 years of service. Again, age 65 with 5 years of service will also qualify you. So tiers 3 and 4 have three criteria: age 60, meet the rule of 80, and 5 years of service. Moving on to the next tier, tier 5 and tier 6, this is the one if you started current membership from September 1st, 2014, and you did not have at least 5 years by August 31st, 2014. This one's very similar to tier 3 and tier 4. It has an age requirement. The age requirement is at least 62, meet the rule of 80, and at least 5 years of service. Also, age 65 with 5 years of service will qualify you. So it's pretty simple. If you look at your TRS annual statement that comes in every fall semester between October and December, you'll look to see what category you're in. What tier number do you fall into? And that's how you begin the process of understanding when you would become eligible for retirement. One question that we always get is, am I grandfathered or non-grandfathered? That's very simple for you to look at. If you were grandfathered, then they would use the top 3 salaries. If you are non-grandfathered, then they would use your top 5 earning salaries. And there is a requirement that comes with being grandfathered or non-grandfathered, and we can speak a little bit more in detail about that if you decide to make a one-on-one appointment. TRS is using financial awareness initiatives for you to start looking at what you have, what you need, and how to get it. There's small short clips that you can see on youtube.com/TRS of Texas. It's just financial awareness, so that way you can understand how TRS works and what you need to do to begin to retire and have the correct financial awareness upon retirement. So let's look at the TRS formula. So the TRS formula is simple. Years of service times 2.3% times the average of either your 3 or 5 highest years of income will give you your maximum benefit. Let's look at an example so you can see how this works. So you would take this individual who has 30 years of service and their average income is $60,000. So plugging these numbers in, you get 30 times 69%, 30 times 2.3% will give you 69%. 69% of the average income turns out to be $41,400. So an individual who is earning $60,000 when they reach the age of 60 for retirement will have a 31% net loss of gross income. So if you're used to living a certain lifestyle at 60,000, just remember that getting to the age of 60 or 62, depending on what tier you earn, you will have a net income loss. In the state of Texas, to receive 100% of your retirement, you must complete 44 years of service. And so to work this formula with your numbers, simply enter your years of service, multiply it times 2.3%, times the average of your 3 or 5 highest income, and you will see what your maximum benefit is. So what are some ways to maximize your TRS? A lot of people will say increase of salary. Well, we say good luck, because that's very difficult, as some districts do, as some employers do offer increases, some districts do, some districts don't. It becomes very difficult. Increase years of service credit. So if you recall from the previous slide, I said the longer you work, the more you'll make. Working 44 years will get you 100%. You can also purchase service credits. And some of the service credits that you can purchase is, let's say, for example, you were in the TRS system, and then you withdrew and you left the school district and decided to go work in the private sector. And then you're back now into the school district. You can actually purchase the years that you were out of potentially cashing out your TRS. Or if you're out of state and you're coming from another state where you were an educator as well, if you were in the military, or you have unreported, or you were a substitute. Now, the number one question everybody asks is, what is the cost to purchase a year of service? Everyone will pay something different. The cost varies depending on the type of service that you are purchasing. And so what we recommend is that you contact TRS for the cost estimate. Remember, your TRS annuity is never reduced by Social Security. This is one of our favorite slides to put on there, because there is some confusion that your TRS will be reduced by Social Security. And unfortunately, your Social Security is reduced by TRS, not the other way around. So let's look at some retirement savings plans. So educators' options for retirement, there's many different plans that you can get. There is the employer-sponsored plans, which usually are 457s or 403bs. There are individual plans that you can get into, such as traditional IRAs or Roth IRAs, or there are brokerage accounts or savings accounts that you can get in, which usually have to do with after-tax dollars. So let's deep dive a little bit more into 457 and 403B, since those are employer-sponsored plans. So the 457 and the 403B are side by side here on the screen. The 457 is what we like to call a group plan. Low fees relative to the 403B, no commissions, full disclosure of fees. The 403B is an individual plan. Most 403Bs have higher fees, you pay commissions, and they are sometimes to limited or no commission options, but there are sales loads. The contribution limits are the same. If you are under the age of 50, then you are eligible for $19,500. If you are over the age of 50, you are allowed to do an additional $6,500, which is the catch-up contributions limit. The 457 has an investment oversight committee. It is managed by an investment oversight board composed of superintendents and CFOs and TCG advisors. The 403B normally does not have investment oversights. Another big difference between having a 457 and a 403B is the penalty to withdraw funds. The 457, as you depart or leave service, you are eligible to cash out your funds. Of course, you will still pay taxes, but you will not be eligible for the 10% penalty. The 403B has a 10% penalty if you withdraw the service when you are under the age of 59 and a half. The investment options are also different when it comes to what the 457 offers and what the 403B offers. In the 457, you have target date funds, risk-based portfolios, or self-directed mutual funds. In the 403B, there are fixed annuities, variable annuities, mutual funds, or custodial accounts. Access to the funds are very easy, as you see, termination of employment, death, disability, retirement, unforeseen emergencies, and loans. Remember, age 59 and a half, you are eligible to cash out your 403B even if you're still employed. Another big difference that we did speak about is fees. We like to call this the fee effect. If you're looking at your screen, you will see that this individual, based on a 6% earnings of net fees, contributed $200 monthly for 20 years at the beginning of the month. If you look, the individual who was paying 1% to have their account will walk away with about $82,549. If the individual had, for example, gotten into a 403B account where they were charging them 3%, the same individual will walk away with less, $65,824. So it's really important to look at what are the fees involved when you are investing in 403Bs and 457 accounts. So watch for your best interests. You really want to be careful with excessive hitting fees, inappropriate types of investments, lack of monitoring investments, life insurance as investments. What we say is retirement stays with retirement and life insurance stays with life insurance. Be careful with words saying pension maximization or any annuity riders. Also, some people will say, take out the partial lump sum when you reach the rule of 90 and we can invest that. Investing the lump sum to beat the TRS system is very difficult. Shadowing market and endorsements. So these are all things you need to be on the lookout for when you are looking at retirement. The next thing that we're going to cover is Social Security issues. We're going to put our favorite slide on the screen again. Remember, your TRS annuity is never reduced by Social Security benefits. So let's talk about two Social Security considerations. There are two regulations that educators need to be aware of. It's the Government Pension Offset Plan, or GPO, which applies to members' spousal benefits. That reduce your Social Security. So let's look a little bit more into the first one, the government pension offset plan. Once again, the government pension offset affects spousal benefit. So you are eligible to receive a benefit in the amount equal to 50% of your spouse's benefit. Former spouse is eligible if married for at least 10 years. You are subject to a 2/3 offset rule. This further reduces or offsets entirety of your eligibility for Social Security payment. The current law says you have to be employed by and retire from a Social Security covered district for your last 60 months to be eligible. So let's look at a GPO example. In this example, you will see that the individual is getting a TRS pension of $2,100. The spousal benefit is $1,000. When you subtract the 2/3 of the TRS benefit from the eligible statement, you will see that 1,000 minus 2/3 of 2,100 is 1,400, leaving the individual with negative $400. This TRS member is not eligible for spousal benefit, but will still receive the full 2,100 TRS annuity. In this example, the spousal benefit is higher, so we'll keep the same numbers, the TRS pension at 2,100. We'll increase the spousal benefit to 1,600 using the same formula. 1,600 minus 1,400 will give you a positive 200. So this TRS member is eligible for spousal benefit of $200 plus the full TRS annuity of $2,100. Let's talk about the windfall elimination provision. The windfall elimination provision, you have to qualify for service credits under Social Security. You have to be eligible for 4 credits per year, giving you a total of 40 credits to qualify for the benefit, which in turn is about 10 years of working. For 2021, to receive 4 credits, you have to earn at least $5,880. Now, the windfall elimination provision reduces and it impacts the individual's own Social Security based on the government and state pension. Using a factor to calculate your Social Security benefit, income is based on years of substantial earnings. So once you qualify for the 40 credits, then you will look at your Social Security statement to see how many of those years are substantial years. So looking at the windfall elimination provision, for example, in 1980, you had to earn at least $5,100. So if you were to put your Social Security statement right next to the windfall elimination provision, in 1980, if you were employed and earned at least $5,100 or $5,101, then that would be a year of substantial earnings. After you've done that with all your years, then you would come to the blue table and you would see here, if you counted and you had at least 20 years of substantial years, then you would be eligible for 40%. If you have a total of 26 years of substantial earnings, then you would earn 70. In the eyes of Social Security, 30 or more years of service will give you 90%. The actual reduction cannot be greater than 50% with 20 years or less. The maximum reduction you can have with 20 years or less for 2021 is $498. So let's look at an example using the windfall elimination. This individual is eligible for $1,500 and has 20 years of substantial earnings. Social Security uses a 3-tier system to qualify for Social Security. So what they do is they take the first 90% of $960, giving the individual $864, and then between 32% and over the $960 through $5,785, the individual gets $172. And if they earn over $5,785, then the individual would have received some extra income. So using the regular Social Security income, the individual will receive $1,036.80. Now, let's look at how windfall elimination affects the individual. So using the exact same numbers, but only having 20 years of substantial earnings, if you recall from the previous slide, you will see that they are eligible for only 40%. So the next one will be 40% of the first 960, giving the individual $384, 32% over 960 through 5,785, and 15%, the difference is the individual would walk away with $556.80. So let's look for some steps for success. Remember that it is a process, not an event. Know your goals. How much will you need for retirement? Who do you need to provide for? Spouse, children, parents, charities, any other quantifiable goals that you have. Choose the portfolio allocation design to achieve investment return needed. Only take the risk that you need to meet that goal. Monitor your investments and choose the investments to meet your goals. Now, at the beginning of the presentation, I told you that there would be a link that you would be able to look at. It is www.tcgservices.com/firstmark. You can click that and make an appointment with a telewealth agent. You can schedule a meeting, access the meeting, talk to an advisor one-on-one. And now the next thing that we're going to go to is our Q&A portion of the presentation, where we will open up. Everybody is available to unmute themselves, and they can ask any question in the Q&A, or you can unmute yourself since we don't have such a large crowd. So I'll take any questions, and you can put them in the Q&A box or in the chat box. Will there be any retirement information for non-educator? What questions are you looking for that we can help you answer? Will you show the first slide of the tiers again? Yes, absolutely. Let me go back to that for you. There you go, Ms. Medina.
Thank you.
If there are any specific questions on these tiers, I can answer them for you. Or if you have your statement, I can show you your statement. You can look to, so we can answer any other questions on that.
Can you confirm something for me?
Sure, absolutely.
You said if you were grandfathered in TRS, if you're grandfathered, then the 3 highest salaries or the 3 last salaries are averaged.
Correct. If you were grandfathered, then they will take your top 3 salaries, and you will see that on your statement. If you are non-grandfathered, they will take your top 5 earning years to show that you're non-grandfathered. And so there is a specific rule when it comes to being grandfathered or non-grandfathered. Would you like for me to go over that with you?
Sure.
So to be eligible for grandfathered, you are a grandfathered member under the 2005 legislation. You had to at least meet one of the following criteria to be eligible for grandfathered. So before September 1st of 2005, you had to be at least age 50. So if you were not age 50, then you had to, your age and your years of service needed to total at least 70. And if you didn't have either of the two, then the last chance you had of being grandfathered, you had to have at least 25 years of service before September 1st, 2005.
Okay, I know my statement, I started teaching in 94.
Okay.
And, but I'm pretty sure my statement says that no, I did call TRS, that I just had to meet the rule of 80. It sounds like you're saying I don't meet the rule of 80. I am 51 years old.
So if you are tier 1 or tier 2, everybody has to meet the rule of 80. So if you look at the screen, you'll see that every tier requires the rule of 80. Depending on when you came in will determine whether or not there's additional steps to the rule of 80. So if you started in 99 and you hadn't had a break in service and you haven't cashed out your TRS, then you are probably a tier 1, right? Which would put you as grandfathered, which would be your top 3. And all you would have to do is at least meet the rule of 80 and have 5 years of service. So if you are the age of 50, then all you would have to have is 30 years of service and you would have qualified.
Okay.
Mhm.
So,
And at 30 years of service, let's say you had 30 years of service, you're looking at getting 69% of your TRS retirement.
okay, I'm still a little confused. So
Okay.
rule of 8, tier 1, rule of 80, at least 5 years.
Mhm.
Or 65 with 5 years. Current
Mhm.
membership prior. Okay, so yes, I had the current membership. And yes, I had 5 years. So that's, I qualify. Okay, and current tier 3. Which one's more advantageous? No, there's no way.
Tier 1 and tier 2 are the best.
Okay, then it looks like I'm a tier 1. I did my math
Mhm.
but I'm not a math teacher. Oh, you can't do the math for me unless you know my 3 highest salaries, correct?
I can do a small, kind of off the cuff calculation. If you know maybe your 3 salaries, I could give you a real quick number.
Let's try salaries of 66, 65, and 64,000.
Okay. So 66,000, 65,000, and 64,000.
Yes,
Okay, so the average of that is going to be 65,000 with how many years of service?
28.
28. So you'd be looking at 64.40% of 65,000 gives you 41,860, which would equate to about $3,488 per month gross.
Yeah, that's roughly what I had calculated, but those numbers I'm not sure on. Okay, now
Yeah,
if we,
so it really depends. It really goes as far as what are the numbers. That was just a real quick rough estimate.
right, I'm tempted to look up my statement. I have it here on my bulletin board. Is there somebody else who has a question so I don't manipulate?
No, as a matter of fact, there is. So let me just answer their question.
Okay.
Give me 1 second.
Okay.
Okay, Mr. Garcia, I just sent you a response to your question, sir. Michelle, I don't have to meet the rule of 80 if I'm 65 with 5 years of service. That is correct. So in any of the tiers, once you reach the rule, once you get to the age of 65 and already have 5 years of service, you automatically qualify for retirement. So if you look, for example, in tier 1 and tier 2, it's rule of 80 with 5 years of service or age 65 with 5 years of service. Great question.
I found my numbers.
Ooh, okay. Let's take a look at them.
So my 3 highest
Yes, ma'am.
are 64,260.
Okay.
65,090.
Okay.
67,210.
Okay, you broke up on the last one. Can you say the last one more time?
67,210.
Okay. If you look at the average, it tells you that your average is 65,520, correct?
It tells me my average here says 64,480.
64,480. Let me make sure I have the numbers correct. You
Okay.
said 64,260,
Yes.
65,090,
Yes.
and 67,210.
Yes. Oh, I know why.
Okay.
Because this statement is from last year,
Mhm.
and that's 26 years. Because right now I'm in the 27th year.
Okay. So let's assume that you had retired this year at
Mhm.
27 years of service. That'll give you 62.10. And you are looking at a monthly benefit of about 3,390.
Okay.
Okay.
Now, if we have private meetings, what will we discuss at those meetings or appointments?
Whatever you'd like to discuss. If you'd like for us to calculate if you stay an extra 5 years, or you have questions regarding your retirement packet, the content of the retirement packet, Social Security, or other investments, if you have a 457 or a 403B with your current employer, there's just a lot of different questions. It's completely
Okay.
open to you.
Are you saying that a 457 is more advantageous than a 403B?
No, I am saying that a 457 is different than a 403B. There are some folks that will see a 457 better, and there are some folks who will see a 403B better. It's really based on what you are looking for and the type of investment that you're looking for.
I see.
Yes, ma'am.
Okay. Thank you.
You're very welcome. Are there any other questions or anybody else that I can assist?
With
Okay.
those, one more, I'm
Sure.
being, with those numbers I gave you, I don't know if you still have them written down.
I do, yes.
What would it be at 28 years?
Sure, absolutely. So then at 28 years, puts you at 64.40%, giving you a monthly benefit of about 3,516.
Okay. Okay, it just helps me decide.
Absolutely. Well, if there's nothing else, then I appreciate everybody coming in this evening. Once again, you can make an appointment with us. If you did not get the appointment link, you can always call us at our advisor hotline at 512-600-5204, and we can be of assistance.
Okay.
Have a wonderful evening. Thank you.
Thank you. Bye-bye.